Yikes, it was a sad day on Wall Street. Big move up out of the gates, but then completely reversed itself into the day's end. Today I want to discuss what happens and how we can prepare if the market continues to just keep heading lower. So I'm going to provide you with some indicators that I use that I've learned recently too as well that really help depict when you could potentially see a bottom in the market, especially if there's more aggressive selling for a stronger sell-off or in the short term as well. So we got a lot to talk about in today's stock market brief. We got some key levels to go over as well. So let's just go ahead and hop in to the show. Welcome back, everybody. Hope you're all having a wonderful day. It was crazy there on Wall Street. Let's take a look at the yields. We're looking at the 30, the 20, the 10, the 3, the 5, and all these pretty colors. But don't worry about which one's which and all that stuff. I'm just going to point out a couple of things. What am I pointing out? Well, yield spreads over here, we're doing just fine. Now we can start to see them still continuing to get closer and closer to one another, which means this right here is flattening. What is this right here? That is the yield curve, the recession monitor, the 10 and 2s, and we have the 30 and 5 spread continuing to point down lower as well. Still far away from inversion. However, it is a big red flag when yields invert. We've had a yield curve inversion recently of the 20 and the 30. Never a good thing that takes place. Typically, it's a good indicator, leading indicator of a recession. So we're continuing to monitor that, but nothing to call out quite at this particular point in time. However, when we do look at the TLT, we said that, it's in this range as it stands right now. So you can typically short into the upper end and then try to take profits either midway or to the bottom of that. But we said, have a strong, a tight risk to reward ratio here. By that, I mean just have a stop loss pretty much above this line. So if you took that trade from a bearish perspective, you may or may not have gotten stopped out. But we did mention that if we are going to start breaking out of this channel that it's in, we're probably going to do so on some sort of insane news event. And well, we had some more news come out around the COVID variant. So if this, puts on the safety trade or, people flood to safety, this thing can obviously break out of this range and head higher, which could put more force on the markets as well. If we take a look at the overall market health dashboard, we're looking at the New York Stock Exchange up here, and then we have some indicators below. Look, we came into the 200-day moving average. The PAPO is just atrocious right now, just below zero, completely sloping down. New highs obviously are very minimal as the market's selling off. New lows keep on the rise as it stands. We had the relative strength ratio cross down in late October. The relative strength line between the New York Stock Exchange and the S&P 500 crossed down below the 50-day moving average, so it has been underperforming the S&P 500. We are getting pretty darn overextended on the namo to the downside, which I'll bring that indicator here shortly. But, when we crossed down through zero, that actually gave us an early warning of this sell-off right here, as well as when the NIAD crossed down through the moving average, the 50-period moving average. Let's take a look at the health dashboard of the Nasdaq Composite. We cracked down, closed severely under the 50-day moving average on a pretty strong move. And we have the bearish crossover taking place, new highs, minimal, new lows continue to build here. But we are once again getting very overextended on the namo, which will bring up that chart relatively soon. And in the NAD, the advanced decline line had gotten below this in mid-November. Below this is the moving average, the 50-period moving average, which is also bearish. You want that obviously to be trending up and above, and you want to be along the market. Now, a couple of warning signs, right? We've been watching this summation index right here, and I pointed out yesterday that, sometimes when we get a below zero reading at the same time the McClellan Oscillator gets a minus 300 reading, it could present warning signs for the market. And it's this time, if it actually had a lower but then bounced and then reverted, these two times it really just tagged the tops almost perfectly, and then we had these pretty nasty aggressive sell-offs when that happened. The reason why I'm pointing it out now again, and we did yesterday, is we are now below zero. We don't have a minus 300 reading on this one yet. This is actually a minus 295. So as it stands right now, I mean, that's such a close reading. I'd say still proceed with caution, and we'll see what what this brings here coming forward. All right, let's continue on. If we look at the BPSPX chart, this is getting pretty overextended to the downside. So I can't be too shocked to see if this is setting up for a Santa Claus rally, because like I said, things are getting very overextended. Now, breakdowns also occur when overextensions take place. But like I said, we have some indicators that we're going to look at to kind of help us, decipher what might be taking place. Here's the BPNDX chart, also getting pretty overextended to the downside as well here, moving into that oversold territory. Things can stay oversold for a long time. So, like I said, this is a very aggressive move to the downside. We're getting overextended readings, have been kind of overextended. So this could be all a setup for, one of two things, really a big rally coming up soon, or a potential breakdown. Now, I don't have the tech stocks charts, the mega cap, the FANG stocks in front of me right now to show you, but keep in mind, those things have been what's holding the market together. And if those continue to sell off and they start losing some key levels, the market can very well head a lot lower. All right, so let's keep moving through this list. Now I'm going to just really quickly talk about the NAMO, which I already really kind of discussed. Just overextend. It's a very, very low reading, which I said, once again, this is where breakdowns can occur. If you take a look over here at the pandemic crash, but also this being, this is just getting completely obliterated. When we had these low readings, typically produces bounces and moves from it. So once again, kind of just goes to that narrative that we just recently discussed. If we look at the NIMO, this is the NYSE McClellan Oscillator. It's also, once again, even more overextended to the downside as we had that big down day in the SP 500. And like I said, even with this one, overextended readings can produce bounces. You can see right here and right here are actually some interesting areas. And I want you to remember actually November, October right here. So this reading and this reading here, because I'm going to pull up a chart here that also is showing a very similar reading, where the chart reading currently is bringing into a very similar type area as it was here. And we know how volatile that area was, but that also tagged a pretty significant bottom. So I will begin. Actually, you know what? I'm just going to do that now. Let's just do that now. S&P 500% of stocks over the 50-day and 200-day moving average. That's what I'm pointing out. You can see here a lower reading on the 50-day, right? So 29%, and then 53% of the stocks there are above the 200-day moving average. So it's almost half and half. But the reason why I call this out is because this reading and this reading are matching very similarly to where we saw that same price action, and those marked actually some bottoms in the S&P 500. So that's what I wanted to really quickly point out there. All right, so now the question is, where should I buy the dip? Is it safe to buy the dip? Look, I don't have a for sure answer for you, but I have some tools that might help you moving forward. So I shared this one on Twitter. This is a more shorter term understanding where if we get an aggressive move to the downside, it's using the hourly chart on the SPY, and I applied a 10-period moving average to the trend. All right, so if you don't know what that is, you can always look it up. It's not. Don't worry too much about what it is at this particular point in time. I'll just show you what the levels do, and then if you want to learn more about it, you can obviously Google it, or I'll try to make a movie about it or something like that. But what I want to call out here is when the 10 period crosses above that 1.5, there's typically a lot of fear in the market, and this is the time from a contrarian point of view where you can get bullish. On the other side of that, when it gets down to these readings where this red line is, there's a lot of greed in the market, and it's typically a time to just let off the gas a little bit, because there could be from a contrarian point of view, you can potentially short it or collect profits. So the reason why I'm calling this out is because the trend has been turning up. Now, I shared the link to this chart that you can bring up any time on my Twitter. So if you don't follow me there, you can follow me there. The link is in the description. But this is a couple of times that this has happened. So it crossed through, and you can see it marked this bottom. That's actually one of the main indicators I use to feel confident about going long at this specific place. And then when we got up into this area, it got a little bit more hesitation, as you probably are all aware. So we tagged that pretty nicely. Right here when it crossed over, it didn't do much. It kind of went up and then dropped back and then kind of just got choppy. So it's not always completely perfect, but it did go up a little bit higher. This one right prior to that, that tagged this significant bottom right here. This one right here, when it crossed up, we actually kind of, it was a gap down, but then you can see that it kind of rallied itself back. This one right here was a false signal. As you can see, it went a little higher, but reverted and then came up. That was mid-May. This was also a false signal where it went up a little bit and then reverted. So it's not like a perfect by any means. But if you calculate this and how many signals there were, you'll calculate 10 signals in this time frame. And 2 of which, maybe 3, depending on how you look at it, were false signals. So that means that there was a 70 to 80% accuracy on this. So in the short term, if you need another ideal in your favor and you're like, you finding a key level and you're like, I think the market's going to bounce here, and you take a look at this and it's actually in the green right here, hey, that actually might be a good opportunity to really lend favor to that overall trade plan. Now let's look at some, if it's more significant of a crash to the downside. If it's a more significant crash to the downside, I like using the PRing bottom fisher. The PRing bottom fisher has been very, very good at tagging bottoms. Not like pristine, but you can see when the PRing bottom fisher and the 10-period moving average cross below this minus 30 reading, but both lines have to cross down below there, and it's kind of rare, right? It's only done 2 times. When they get back down below there and then the blue line crosses up through the green line, which that means the PRing bottom fisher indicator itself is crossing up through the 10-period moving average. So right here, and then you can see it was right there that it took place. It has been pretty darn good at tagging bottoms. Not like spot on, but pretty darn accurate. And that was the 2018 crash. We'll call it what it was. That was a pretty nasty time. And this was the pandemic crash. So if it gets like that, which it's not necessarily what I believe, but you know, what I believe, it really doesn't matter. It's what happens that matters, right? You can have 1,001 narratives, but the market is going to be right. If the market wants to move down, the market's right to do so, right? Who cares? You know, don't hold too strong of convictions. Here's another one. The Nasdaq going HiLo. Now this one is really interesting. If we get a a 0.05 reading on an overextension, which are kind of moving down pretty significantly there, which is weird actually. We're moving down at a pretty decent rate, but the market hasn't even really moved all that much. But if we get down to these readings, it's been pretty darn good at finding bottom. So you can see here, 2016, didn't tag it perfectly, but you can see that that was after a sell-off. 2019, once it got down and crossed back up through, you can see that was actually kind of late 2018 to early 2019. That was that bottom right there. And then the pandemic right there too as well helped tag a bottom. And then we have obviously the financial crisis, and that was all kinds of chop. You can see just boom, 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 hitting like that. But you can see here it started to turn back up. So all this chop down in this range, you know, obviously there were some warning signs, but when we did start to spike back up through that rapidly, it did show an early sign that we found that bottom. So it's been accurate for the most part overall. The next one I learned from somebody on stockcharts.com. His name's David. I always can't pronounce his name, but I really like his charts, so I want to share some. But this one is a good tool to help potentially find bottoms in the Nasdaq. And the Nasdaq, this is the RHCOMPQ, the Nasdaq Record High Percent Index. But this is the ticker symbol if you want to pull it up on stock charts. And then what you do is you make the chart invisible, but you apply a 10-period EMA. And when you do that and you see that we get these sub like just under 20 readings right here, boom, 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 basically everywhere that I highlighted the vertical line. When you get a reading like that and then it crosses back up through 35, that's the key that he pointed out, crosses back up through 35, that produces that bottom quote unquote signal. And you can see here, this was leading up to the blow off top in the 2001.com, and you can see the market, it doesn't look like much, but that was a big move from up here to a low of down there. And you know, it was a pretty nasty move, especially when the composite was sub 2000. It was just, where was it? It was probably around what, 1800, around there, and then it sold off a few hundred points, which is a pretty large percentage, and then it just took off like a rocket ship overall. And then it found somewhat pretty closely to the bottom of the dot-com burst. It found pretty well the bottom of the great financial crisis. See what I mean by these are much more significant. This one right here before it started taking off too as well. This was more chop range. This right here, 2016, and then obviously that 2018 pretty nasty hit to the downside as well. It caught it for the most part. You know, you're missing out on a few points, but if you're a long-term investor and you're trying to quote unquote buy the dip, these indicators can really help you point out like, okay, now is the time that I should probably add more to my portfolio. It's there's a lot of fear. There'd be a lot of fear. Keep in mind, what's the psychology of people in these areas? Full on fear. Like, without a doubt, people are frightful. So if you can see this taking place ahead of time, and then you can position yourself and position your mind to think a lot differently in times of panic. This video is also, it's going over a little bit longer than I wanted, but I guess that's okay. We'll look at the market dashboard really quick. All 11 sectors of the S&P 500 were almost down, but utilities was slightly there in the green, healthcare and consumer staples, so defensive. Obviously, these guys at the beginning of the day, they were more towards the bottom of the list, and as soon as that news hit, we saw that rotation right back up to the top, and you can see here, everything was down on the day. That was a significant move down on the day for the Nasdaq 100, down 1.6%. So it's weird to see the Nasdaq 100, the Nasdaq composite, as being the most down. We haven't seen that for quite some time, it seems like. Let's hop into the S&P 500. Let's look at some key levels to potentially pivot off of. We landed on the 20-week moving average, so that can actually act as a pivot point. But if we get continued selling, the 30-week moving average has acted as a pretty strong level of support. The 30-week moving average right now is at 44.20. So 44, this mouse, I swear, 20, okay? So that would be the level that you can potentially play a pivot off of if we get more selling too as well. Keep in mind, I looked at the move of what the options market was pricing in. Just till Friday, it's pricing in now a $93 move, but at the beginning of the week, on last Friday, it was pricing in a $150 move. And if you're focusing in on that, that's only around 44.75, I believe it is. Would 44.70? Yeah, 44.75. So about 40-ish points away, if I remember correctly, to hit the expected move is what the Theo team has termed that, the expected move. All right, so let's go ahead and continue on. S&P 500 on the daily time frame. Not too far from the 100-day moving average, so look at that as a potential pivot. That will line up with some previous area of resistance. So there we go right there. This could be a exhaustion, puke type move, and then it's going to set up for that rally. It's so early to tell right now, but with a lot of these indicators being just completely burned to a crisp, it's kind of like, oh, this might be a huge rally coming from it. But what throws me off so much is that big tech is still doing very well. So if you look at like Nvidia, right, Microsoft, Google, they have killed it this year. And if they keep continuing killing it, then why wouldn't this turn around and all the other stocks try to run with it? It's just a couple different ways of thinking as of right now. Here's the 15-minute time frame for the SPY. We were talking about this little wedge yesterday, and we said I wouldn't be surprised if it runs up, but look where it tagged the 5-day moving average, and it sold off. Very big puke into the close. That was very nasty. You can look at this PMO indicator, and it's all over the place right now. Price action's going absolutely bonkers. So it's an environment to be very cautious of as it stands right now. Still in bearish context. We have lower highs and we have lower lows being built out. On a positive note, right? We still have that positive divergence. We have somewhat of a positive divergence here too as well. So I wouldn't be surprised once again if we start getting these, this keeps happening at this particular point in time. We need to get back above the 5-day moving average, and we need the 5-day moving average to start sloping back up again to feel a lot more confident. If you take a look at the VIX did print another high today. So we'll see here if it wants to reach up and grab that, I think it was 40 to 44, 45, 46 range is where that kind of gap that we talked about a while ago is still open up there. So if it goes up, maybe that would be the area to potentially start looking for some longs. As it stands right now, we do have a little negative divergence taking place. You can see a high to a higher high, and we have a high to a lower high right there, which could say, okay, we might take off a little bit right now. As far as backing down a little bit on volatility. Top into the Dow Jones. Dow Jones cracked that 30-week moving average completely. Right on a weekly time frame, down 2.51%. If you are an aggressive dip buyer, we talked about this being a pivot area right there, the lower Bollinger Band, and you can see here it's acted as support multiple times. Right here, right here, right here, right here too as well. Gosh, my mouse. Can't tell. I gotta get a new mouse, I think. So perhaps, this fear, it's just an exhaustion move, and that's a good opportunity if you're an aggressive buyer. I like to be a little bit more cautious. I would like to, if I think that this is going to be the support area and price comes down through it, man, I might put a buy stop order or try to find some hedge longs. And my buy stop order, it won't get triggered unless the price comes back up and picks it up. If it picks it up and then, it found the bottom right here, but I got in right there, well, okay, that's fine with me. I don't need to tag the perfect bottom. I just want to catch the right up is how I would personally look at it. The Dow Jones on the daily time frame, just absolutely getting obliterated. You can see the 200-day moving average was given up. Let's see if price action wants to get back above it. But like I said, we have support there, support there, support there. Where is that level at? It's around 34,000 in that kind of zone to around 33,500. So it's a little bit of a range as it stands right now. And also the indicator right there, the RSI is getting a little oversold, to say the least. Let's keep moving. 15-minute time frame. Once again, it's a very similar story. Not going to spend too much time. Had the positive divergence, falling wedge, but we said that it was in bearish context. So you need to be aggressive. Gapped up, moved up higher, and then it rolled itself over. Context remains to be bearish. Let's go to the Nasdaq 100. Nasdaq 100 gave away the weekly 5 EMA, but the week is not over yet, so anything can take place. Start looking at 15,500 and 15,000 for the pivot areas if you want to be long tech. Okay, that's the 30-week and the 20-week moving averages. Let's go into the daily time frame. The daily time frame perhaps is playing out that head and shoulders pattern. Like I said, this is a very aggressive move on the Nasdaq 100. We haven't seen a move like this for a little while, and it did crack down through that neckline. So perhaps it does come down. Maybe it bounces back up to retest and comes down for that full move correction, which is around here for around 10% of a move. And that's where I'd be paying close attention to for hedging long. But as it stands right now, we are trading, really just in this range. We have resistance right here at 15,705. So just be mindful of that, right? So we can reach down a little bit more. Perhaps it bounces, everyone feels good, and then maybe it takes off, or maybe we just keep going. So not exactly the type of environment that I want to just step right into. If we take a look at the 15-minute time frame, look at this price action. It's very hard to create trade plans when things look like this. And you can see here, it's coming down into this previous area. Oopsies. This area right here, 387. It's kind of in this area of previous support, so perhaps bounce back up, but we need to recoup this 5-day moving average, and instead of it being a spaghetti noodle, we need that to start curving up. So as it stands right now, it's still a neutral environment. You need to be very cautious. Russell 2000 continues to get just obliterated, down 4.3% for just this week, and we still have more trading days to go, well below the 30-day moving average. And overall though, still within this kind of channel that it's been trading in for a very long time. So, hey, if you got the courage, you can try taking a hedge long here if it reaches down a little bit lower, and then that might set itself up for just a rally into the Christmas season, right? If it wants to match that seasonality script. But you got to just be careful. So if you're trying to tag a bottom, make sure that you're managing your risk. Like I already previously stated, if it's in a channel like this, and it breaks down, and now you're like, where's the dip? Where's the dip? Maybe I'll just buy here, 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 or wherever. See, that can be very dangerous. However, you know, if you look at it in this perspective, and I see it, I'm like, okay, I think it's going to come back up and rip. I'm not trying to tag the perfect bottom, so I might put a buy stop, you know, just above it. And if it keeps selling, then I'll be like, okay, I'll take that order off the table. But if it comes down a little bit and then all of a sudden rips to the upside like that, well, I'll be able to catch that move. Okay, so you need to be strategic in order placement here. IWM on the daily time frame, you can just see just in a crazy move. This could be an exhaustion bar where it just puked out the remaining people, right? Like everyone's like, nope, it's going to crash further and further. So everyone, retail just sold out of all their positions, and that sometimes can produce really crazy bounces, all right? So like I said, we're pulling into these previous areas, right? So not too far off. Not too far off, and that might present itself a bounce to the middle of the range or even the top end of the range. We are getting overextended there to the downside as well. It's a very difficult environment to navigate, so don't pretend like it isn't. Don't try to be a hero, just be prepared. If you take a look at the 15-minute time frame, look at the bearish momentum on the price action. It's getting weaker and weaker. Once again, still, the PMO and the RSI are showing that the bears are getting not as strong. The momentum is slowing to the downside. So that's why I'm thinking maybe perhaps this could be like a puke out session, but still, that doesn't mean it's going to be a perfect trade. We still need this 5-day moving average. We need price to get it back above that. We need this, instead of sloping down, to start sloping up. And if you do look at this, it was my mouse. If you do look at this, this could be potentially like a very, very tight wedge as such right there. And it's doing so on those positive divergences, right? But once again, it's in bearish context. So we move up. Oh my goodness. If we move up, watch that 5-day moving average to recoup that level. That's what we would need to get back above. All right, let's go into a couple commodities. Energy. Well, not energy, sorry. Oil. I think OPEC meeting is tomorrow, tonight. I can't remember exactly, but that's a lot of fear going into it. So that was a big move to the downside. So also I'm thinking, if we maybe stretch down a little bit further, this could present an opportunity also for energy stocks, because if we do get some decent news out of that, this could be, you know, a kind of a puke session, like I've been saying, and then we get this monster rally. So right now, it's like I said, I wish I had more data, but as it stands right now, the volatility is rather high in all these index products. Gold is the last chart that we'll go over, and gold has done really nothing. So, you know, not much to say here. I want to see it get obviously back above 1840 and 1800, right? 1800 is more of that middle kind of area of this channel here. So if we get back above 1840, it'd be looking good. But as it stands right now, you know, it's all over the place, and you know, it's just a very weird creature at this particular point in time. All right, everybody, that's all I got for you. I hope today's video helped you all out. If you haven't done so already, I really appreciate it if you hit the thumbs up, subscribe to the channel. I will see you all back tomorrow.